Good day, everybody. Welcome to the Deal Scout. On today's show, we're going to have a conversation with Mr. Ron Diamond. We're going to talk about family offices, private deals, and all sorts of cool stuff. But as always check with legal, always check with your attorneys and accountants just to make sure that you guys are making wise decisions, because what you're hearing from me and from my other deal makers are their experiences. But let's dive into today's conversation. Mr. Ron, welcome to the show.
Glad to be here. Thank you for having me.
Yeah. All right. So if we met in a coffee shop and I said, "Hey, I'm Josh," and how would you introduce yourself and what do you do?
In a coffee, I'm Ron. I'm married for 28 years, got two daughters, 23 and 20, from Chicago. I would talk about what I do. I mean, who I am.
Interesting. All right. So when you talk about, who you are, you go straight to your relationships with your family, where you live, your kids. You didn't even touch on what you do. Um, do you think as founders, investors, deal makers, do you think we get caught up in our identity of so much of what we do? And because you even said that's not who I am, it's just what I do.
100%. And again, I was different when I was younger, but I just think that's the way I view the world right now.
Yeah. Let's go back to when you were younger, right? Every story is when you were younger, but let's go back to when you were younger, when that was your identity, and what switched for you? Because you say that's not how I am now. I'd love to hear the transition in your evolution story.
So I graduated from Northwestern, and my first job was at Drexel Burnham. And Drexel, for people who are younger, it was Goldman Sachs on steroids. It was the most profitable firm on Wall Street. And I was there when Michael Milken, worked at Drexel, when Drexel went bankrupt. And I'm in the room, I was 24, and I'm in the room with people in their 60s and 70s. And in the late 80s, you didn't typically see men openly cry. And it was a surreal scene. And I could remember it very vividly. I could remember colors, I could remember scents, I could remember who was wearing what positions. And my takeaway from that was, a lot of these people had lost most or all of their money because they have kept it in Drexel stock. And that's not who they are, but that, I mean, it was obviously a big part of it. And my takeaway from that was that I would always be extremely loyal to people, incredibly loyal to people, but I would never be loyal to a company because a company is just a company. And I think that's sort of like what spurred this whole thing on. And then it was an evolution over the next 15, 20 years. But that was clearly impactful.
That's so interesting because when I was growing up, the advice to me when I was, in high school and getting ready to go to college, my dad was get your degree, go get a job, work there 40 years, retire, get the golden watch and retire, because he was in construction and he was swinging hammers and, in working labor. He didn't want that for his kids. Now I followed suit and I wanted to get in that kind of world, but I, the being loyal to people, not companies, that's a unique approach. Now here you are, fast forward, you are involved in the world of family offices, and you work side by side with some very successful people. How do you think your shift in mentality affects what you do today?
It's made a major impact. It's just how I view my life. Like I don't I look at things much more holistically. Um, and you get to a point in life where I'm at a point certainly where I work with people who I want to work with when I want to work with them. And I used to think that I always wanted to work with like the smartest people, and I do want to work with smart people. But I've learned over the course of years that intelligence is a commodity, integrity is not. And what I try to do is work with really good people who I trust implicitly, who happen to be bright, but they're good people to start. Life's too short otherwise.
Intelligence is a commodity. Intelligence is a commodity. Integrity is not.
Correct.
So, okay. So how do you, all right. So now let's get to this. What do you do? Right. So let's talk about what you do. I know that it's not a part of your identity, but tell us what you do, because I'd like to know with what you do, how do you go about choosing the right people that have the right metrics that you measure?
So when Drexel imploded, I started a hedge fund. I ran it for 10 years, sold it and started investing. And what we currently do, I have a syndicate of about 100 family offices, and these are families anywhere between 250 million up to 30 billion. And I kind of act as a quarterback, and we invest in the private markets. That's private equity, venture capital, real estate, and credit. We don't charge anything, but I'm doing it so I get better deal flow and execution. And I know who likes what. So if it's a venture capital deal, of the 100 families, there's 13 that like venture. If it's multifamily real estate, there might be 42. So I kind of know who likes what. If they want to come in, great. If they don't, that's fine too. And we typically create an SPV and structure a deal. So that's the main thing that I do. I sit on a few boards, and I put together the family office initiative at Stanford University and started that. And we're in the process of starting a family office center at one of the top schools in the world, which will be announced publicly, I think, in about 3-4 weeks.
Yeah, that's very exciting. I'm happy to hear that. So when you syndicate, 100 family offices, you're very clear that on specific types of people you want to work with. All right. So what kind of indications when you're looking at a group, how do you determine who you want to work with and who you don't want to work with? Because that happens with the groups that you syndicate with through SPVs and the companies that you may invest in or work with. How do you determine, what do you look for as a red flag to say, I'm out, not dealing this?
I don't think it's an exact science. I think that it's more, obviously I'll do diligence and do background checks, and anybody who knows these people who've invested with them before, I'll find out from them what their experience is. But when a deal's going well, it's very easy for the GP or somebody to say, yeah, the deal's going great, we're making a lot of money. That's not really what I look for. I want to know what's going to happen when things go bad. Because again, very few deals go straight up, right? So how do they react when something bad happened, and what kind of character do they have, and what kind of people are they, and how honest are they? And I think that looking at through that metric, I found more success than what I used to. I only wanted to work with PhDs from Stanford and that kind of stuff. So I look at the world through a different lens right now.
Yeah. How long have you been in the industry? So you got into, building a hedge fund, and then from there you moved more into family office and syndication. Like, how long have you been in family office syndications?
25, almost 30 years.
Okay. So 30 years of being in the trenches, 30 years of experience leads you to gather certain wisdom, certain golden nuggets that a younger guy, much younger guy, not much younger, I don't know how old you are, but there's golden nuggets that I want to capture from maybe painful lessons that you've learned the hard way, right? And when I sit across from someone who's been in the trenches that long, I want to know. So what are some warning signs, some things that hurt if we don't, younger deal makers, if we don't make these choices now in our life or prepare to make these decisions or partnerships, whatever that might be, what could I look out for to protect me from making the same mistakes you might have made over your career?
I just gave a keynote at Oxford University, and they have a family office initiative there, and I've done at Stanford as well. And one of the topics I talked about, because I'm dealing with 25, 30-year-old kids or young adults, and what I said is that, and I was the same way. This is a marathon. This is not a sprint. And when you're younger, you just want to get from A to B and B to C and C to D as quick as possible. And then you get to a certain point, and then you want to get to the next point. And I think that the biggest advice that I can give to people is, A, be true to yourself, be authentic, surround yourself with good people that you trust implicitly, that are positive, because negative people can really corrupt your mentality. And look at everything you make, every decision you make, how's it going to impact you in 10 years rather than in 10 months or 10 weeks? So a lot of times people are very myopic when they're younger, and I was certainly like that as well. You want to do really well right away, and et cetera. It's a long game. And I think what I've found, and I can't explain it, but the more you give, the more you get. And I can't explain it intellectually why that is. But before I wanted to get, I wanted to get, if I ran a hedge fund, I have a lunch with you, and I knew you had the ability to invest $20 million, my goal was to have that meeting and have you invest the 20 million. And now I really, I try to learn, I listen a lot. I was bad at listening. I'm good. I'm not great. I'm getting better. Listening is a skill that most of us are really poor at. And I try to surround myself with people that are older than me, wiser, smarter in different fields, and listen as best I can. I mean, my dad was a very successful banker, and he used to tell me, he's like, you could always tell at the board meetings who the lawyer was and who the entrepreneur was. So the lawyer was almost typically, they would always try to show that they're the smartest guy in the room. He said the entrepreneur, sometimes they're outgoing, sometimes they're not, but their goal is really to find the smartest guy in the room. And that's really what I look at for myself. I just try to surround myself with people that are smarter than me in various verticals that I trust implicitly, and then life works itself out.
Yeah. You say the difference between the giving mindset and the getting mindset. When we talk about, investment groups, their primary role as a GP is to maximize profits, to minimize risk, to, work on tax strategies, right, for these kind of groups. Like, how can an investment group, we have a lot of investment groups and GPs in the area and fund managers. How can we have that mindset of giving versus a getting? Like, give us some input on how to make that adjustment.
I'll give you a perfect example. I'm at a conference, a family office conference in New York. This is like 4 years ago. A lot of people at the conference, and I was doing one of the keynotes. But before the talk, I was talking to a friend, and then another friend came up, and I'm like, "Oh, by the way, you guys should talk to each other. I think you'll get along, and tell them what you do, etc." And then I left the conversation and introduced them. 10 minutes later, one of the guys came up to me. He's like, "Why did you introduce me to that person?" I'm like, "Why? What do you mean? What did he do?" He's like, "Was he offensive?" He's like, "He's not going to invest in my fund." I'm like, "What are you talking about?" He's like, "Well, I came here to raise money, and he's not an LP, and so why did you introduce me to him?" And my takeaway was, well, I really didn't come to this family office conference to try to raise money for you. I thought to introduce you. You're both good human beings, and you're smart people, and you're thoughtful people, and get to like each other. I wasn't doing it as a quid pro quo. I was just doing it because I thought two interesting people like each other. So fast forward, I would never ever introduce that person to anybody who's looking to raise money. And we've raised billions of dollars. And again, it's just that mentality that I want something now. Um, I think there's a book called The Go Giver,
Yeah.
which is a really good book. And if you constantly put stuff out and you're constantly giving and giving and giving a lot, and then you don't even remember some of the stuff you've done, and then somebody will come back and say, "Oh, you helped me here," or "You did this for me," or "You introduced me to that person." It just comes back, and which is the opposite of people who are pathological liars, who if you lie all the time, then all of a sudden you have to remember who you said what to and when, right? So it's basically putting out good stuff. And again, I'm not naive. I'm not just gonna um it's not just to be a saint at all times, but I do think that there is something in the universe that is that the more good you do, the more you give, the more you get, and I can't intellectually explain it.
Yeah, there's a lot of stuff that I cannot intellectually explain either. I'm studying right now, and I'd love your thoughts on this. The idea of one pocket, they call it one pocket investing, one pocket giving, where it's both kind of coming from the same pocket. Because I think sometimes people go, I'll make money, and then I'll do this with my investment dollars, and I'll do this with my philanthropic arm or my giving dollars. And this strategy is kind of like they both should be one and the same. How do you approach I got to take a sidebar here just for a second. Someone made a comment on one of my things that says I ask questions far too long, so I apologize. Sometimes I have to set them up well, to give you a bump set spike so you can spike it on me. But back to the question, how do you approach philanthropy? What does your mind do towards the world of giving? How do you think about that versus giving?
Well, so my North Star, my dad passed away from prostate cancer at 57. And my first boss was Michael Milken from Drexel, who developed prostate cancer. When my dad got prostate cancer, he went to 3, 4, 5 of the best doctors and he did everything he could. He lived 4 years and then he passed away. What Milken did is he built basically, rather than going to the 4 or 5 best doctors, which I'm sure he did, he built it like a venture capital firm. So he wanted to save his life, but he basically put $2 million into this idea, 500,000 here, 3 million here. He invested almost $100 million, but he built it like a venture capital firm in order to save himself. And because of Michael Milken, you, I, and most male listeners, if we live long enough, will die with, but not of, prostate cancer if we live long enough. You could look at what Eric Lefkowski, his wife, he's the founder of Groupon. His wife developed breast cancer. Well, he didn't like the data, so he was trying to help save his wife. Well, as a result of that, he built a company called Tempest, which is a publicly traded company, which is worth billions of dollars. But that wasn't his intent. His intent was really just to help his wife. So my North Star is I don't think you could run a philanthropy exactly like a business, but you could run it more business-like. And you can take these entrepreneurs, you could argue Bill Gates did more for the cure of COVID than the US government. You could take these entrepreneurs who have the means to do it and have a passion, and they're touched by autism in their family, or they're touched by cancer or diabetes or whatever the cause is, or poverty. Um, they can make change. So I don't think that a lot of these big world problems are going to come from the government. I don't think they're going to come from corporate. I do think they're going to come from a lot of family offices who have the means to do it. It's not a panacea. They're not going to solve all the world's problems. But I do think that families who have the means to do it and think like an entrepreneur and can run their business, their philanthropy more like a business, they're the ones that are going to solve these problems. And I think that's where it's going to come from.
Yeah. So the I have two questions kind of plaguing my brain that I need to ask. Moving from hedge fund to family office, what are the different mentalities? What are the different mandates? What are the different thought processes, the different lifestyles? Like talk us through hedge fund versus family office.
Well, it's interesting. First of all, the family office model is completely broke. I mean, right now, everyone's got a family office, right? I have a family. In order to make it to make economic sense, you need about $250 million to have it make economic sense. Otherwise, you're better off in a multifamily office. But the point is the model itself doesn't work. Only 25% of family office make it to the second generation, and 10 make it to the third, and 5 make it to the fourth. So you're dealing with a model that doesn't work. And 68% of the family offices started since 2000, and half started since the crash of 08 or 09. So this is a very new phenomenon. It's very fragmented, it's very siloed, and it's very inefficient. So the way I look at it from a macro standpoint is, as private equity and venture capital disrupted the public markets in the mid-'80s. So I ran a hedge fund. So if you're running a company and you've got to report to me or analysts on Wall Street every 90 days, it's very hard to do. You're basically managing earnings, right? That's what people do. If you're a privately held company, you don't have to worry about that. So I think private equity and venture capital in the mid-'80s started and then exploded. It was a better model. I think what's happened, and I'm generalizing, but it became an extraordinarily lucrative business. But in general, a lot of, not all, but many of the private equity and venture capital firms, it became an AUM game, and it's a conflict of interest. And I had a good friend who did a roll-up of logistics companies. He needed $150 million. Placement Idea was able to get him 500. He said, okay, terrific. I just need 150 and we'll get started. She came to his house or apartment in New York and wrote down, like he's a 10-year-old, like 2% of 150 million equals X, 2% of 500 equals Y. What am I missing? And what my friend, who was a bit incredulous, said, well, if I do what you want me to do, there won't be a fund too. Because yes, I'm smart enough to know I'd make more money today. 2% of 500 million is more than 2% of 150 million, but I can't deploy the other 350 million. That's a microcosm of what's wrong with the industry in general. So I think it's become an AUM game. So I think as private equity and venture capital disrupted the public markets in the mid-80s, I think that family offices are starting to. They will never replace, but they're starting to disrupt private equity and venture capital because that's a better model. So if you look at a typical deal, a private equity deal, private equity firm buys a privately held company that maybe they've been held for 70 years, and they're going to hold it. And I could tell you how long they're going to hold it. They're going to hold it for 3 to 5 years because that's how their compensation structure works. So they're going to then sell the company. So private equity firm A buys a family-owned business, and they're going to sell it. And oftentimes, who do they sell it to? Private equity firm B. So you've got really smart people on one side say it's a good time to sell, and really smart people on the other side saying it's a good time to buy. And then over the course of 20 years, and they're going to hold it for 3 to 5 years, and then they're going to recycle it because that's how they're compensated. Over the course of 20 years, a company could change hands 3, 4, 5 times. And if you look at the taxes, the friction, the inefficiencies, and the disruption in business versus a family office who could simply has something called permanent capital, which is the biggest value add that family have. They could simply buy it, hold it for 20 years and let it compound. The results aren't even close. So a family office doesn't have a shot clock. It is a superior model than the private equity model. The problem is that very few families right now can execute. So we've done work with the Pritzkers or the Crowns or the big family offices. They can execute. Paul Carbone is a friend. He's got a team of 65 people. He works for the Pritzker family. They can compete directly with Carlyle and Blackstone, and it's a superior model. Most family offices can't do that. I think what's going to happen is as people realize that this has become an AUM game, and as more of the family offices become more sophisticated, I think more and more people, when they sell their company, they have two options right now. They could sell it to a strategic, or they could sell it to a private equity firm. There's now a third option, which is to a family office. And a family office will typically never pay the most money to buy the company. But if you care about people in the company and you want this to last generation after generation, you're much better off going with a family office. If you just want to get the highest price and get out, and you're not that you're a bad person, but you're not focused on what happened, you're going to always be better off selling to private equity, because private equity is going to always, they'll pay and they'll overpay. And what happens is they've raised billions of dollars, and they've got two options. Either they deploy the money, which they'll do 100% of the time, or they can give the money back to their investors, which has happened 0% of the time. So what it happens is during periods of like 2019, 2020, when the market was overvalued, we'd see companies that we thought were fantastic, and we were going to buy a company, but then a firm would come, a private equity firm would pay twice what we think it's worth. And it's like, it's not even close to worth that much, but they had to deploy the capital. That's a problem, and I think that's going to flush itself out. And that's one of the reasons why we're trying to do it at the university level, because right now the top kids at the universities, they want to get into private equity or venture capital or real estate, hedge fund, et cetera. Nobody wants to go into a family office. Nobody knows what a family office is. So by educating these kids, remember, there's $84.4 trillion coming downstream from the baby boomers of the next gen. So
Yeah.
we're about to experience the largest transfer of wealth in the next 20 years. And I believe in 5, maybe 7, maybe 10 years, the first choice of these kids out of Booth or Harvard or Stanford is going to be to work for a family office, not private equity or venture capital. It's not that way now. And we're going to start with the education.
All right. So this idea of permanent capital versus a fixed flip, buy fixed flip, 3 to 5 years to the next private equity, the next, financial buyer down the line. What does a family office need to have in place to do that? Not just money, right? They have to have operations, and they have to have these kind of assets or people under. Like, what does that look like to be able to build that financial model, that machine?
So that's a great question. The first thing they have to understand is the compensation structure. So I'm generalizing, but right now, most family offices, and I said, they're very inefficient, fragmented, and siloed in general. If they're going to pay a kid at $250,000 out of Stanford, most family offices look at that as a cost. It costs me $250,000 to hire this student. If Blackstone or Carlyle or Apollo hires this kid out of Stanford and they pay him $250,000, they look at him as a potential $20 million profit center, not a cost. So it's nuanced, but until you start looking at it as a potential profit center, as a cost. So family offices have to understand that, because these people, everyone wants to do well and make a lot of money. And in order to do that, you have to compensate these people in the right way. So first thing they have to do is get the compensation structure model right. Then they have to build the team. They have to build the infrastructure. They have to have you need a lot of money to do this. That's why, there's people who sell their company for $100 million and they start a family office. And I'm like, you shouldn't do that. I'm like, I don't judge anybody, but objectively, it's not enough money. You need a minimum of 250. I would argue maybe 500 million if you're going to invest in private markets to start a family office, because you have to hire a team and you have to compensate that team and you have to hold this thing and you're going to hold it long term. So there's a whole bunch of things that has to happen. But today, in general, family offices, again, I'm generalizing, they had a liquidity event, they sold their company for $1 billion, they start a family office, they take their foot off the gas pedal. If you're going to do that, which is your prerogative, don't start a family office. Unless you're going to run it like you ran your business, like it's a full-time business, don't start a family office. The family office that can do that and understand it and have the resources to do it and understand, they can compete directly with the private equity firms, and it is objectively a superior model. It's just very few people can execute. I think in 5 to 10, more and more will do it.
Yeah. The mindset of the example you just went, guy or gal builds a company, sells it for 100 million bucks. So your mindset is to grow, 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 grow. Now you've got this nest egg, and now you're kind of like thinking future. You're more thinking maybe preservation and legacy versus maybe I got to build this thing as big as I can to sell it. Do you think that family offices that don't have that upward trajectory in terms of growth mindset and appreciation of capital, like, is that where there's some fallout?
Well, I'll tell you where there's the biggest fallout, in my opinion. The
Okay.
biggest obstacle, competitor to most family offices is the ego of the founder, the matriarch or the patriarch. And what happens is you built 5 Hour Energy or Beanie Babies, or Ty Warner is a perfect example. He built Beanie Babies, and I know him, and he did an incredible job building a collectible and making them hard to get. Sold it for billions of dollars. Then he goes out and buys hotels and gets crushed. So I think the point is that just because you're good at something doesn't mean you're good at everything. I'm very good at certain things. I'm horrible at certain things. And the ego, when you have a company and you sold it and you had a lot of money, everyone is sort of like kissing up to you and looking up to you, because you sold a real estate company and you sold it for a lot of money and you were really good at multifamily, doesn't mean you have any business investing in venture capital, but they do. And that's the biggest problem. So it's really a mindset, and a lot of you have to take your ego out of it and realize that I'm not a good venture capital investor. Okay. I work with people at Stanford and I surround myself with people that are a lot smarter than me. If you take your ego out of the equation, this works a lot better. But as you could see with like the debate that we just saw with Trump and Harris, Trump couldn't take his ego out of the equation, and as a result of that, you know, she eviscerated. And I think that more and more families are realizing this. The younger generation, you said there's two buckets. There's here, I'm gonna make as much money as I can, and I'm gonna give as much money as I can in the other bucket. Impact investing really started with the younger generation. It's not the older generation. So, when I was younger and I bought a pair of jeans, I basically bought it based on how it fit, how it looked, right? My daughters, they're 20 and 23, they're wonderful human beings. Not always the easiest to raise, but they're wonderful human beings. And they want to if they buy a pair of jeans, they want to know who made it, how do they treat their employees, how do they incent where's it made? And they have access to this. It wasn't that I was a bad person. I had something called the Encyclopedia Britannica. My daughters, it's not that they're necessarily better people. They have access to this stuff and they won't buy a pair of jeans from that. That's how they look at the world. And I think the younger generation, because there's so much information with the internet and everything, that they look at things so that's what impact investing did. So this third bucket, which is I'm not going to invest in a company that invests in fossil fuels, or I'm not going to invest in a company that outsources everything from China or pays their people, whatever. That's information that the from the younger generation on up rather than the older generation on down. And with 84 trillion coming downstream, the younger generation, and they're much more comfortable with technology, they're going to really be driving the ball. I would argue if you look at my generation versus my daughter's generation, there is a bigger change between my generation and my daughter's generation. I think you can go back past the Industrial Revolution. There's never been a bigger change with things like the internet, and now we've got artificial intelligence. So I think we're at an inflection point, and there's so much information coming in so quickly. So what's fascinating with the family office space is that it is fragmented, it is siloed, it is inefficient. It is a objectively better model if you can execute and you know how to do it. And that's what we're trying to do at the university level. A lot of the problem is a lot of the conferences, and I keynote a lot of these conferences, and these are friends of mine, but the investors that invest alongside me say, I see your keynote at this conference. Should I go? I'm like, no. Like, well, which one should I go to? I'm like, very few. And the problem is that these conferences, in general, they're pay to play. So if you're speaking, you might be really smart, but I know you spent $25,000 to speak, and that's not why I should be listening to you. So what happened is the family office conferences now, it's service providers pitching to service providers, and very few families go to it. So you have to get it done at the university level, which is they're nonprofit. And that's why I did it at Stanford, and that's why we're doing it at the new school, which will be announced publicly. I think that's where you have to galvanize it. That's where it has to happen. But I do think we're at an inflection point where you're going to see massive changes, and family office are going to make a huge difference, not only in the way companies are bought and financed, but my North Star in the way company and philanthropy is utilized. And that to me is my North Star.
Yeah. It's like watching two sales guys sit down at a table together trying to sell each other, a vendor pitching to a vendor and that's what we see from some conferences, isn't it?
Oh, at most conferences. So, but you have to do it at a university level because, again, at university, what's their agenda? I mean, maybe they want a wealthy guy to donate a building, but they don't have they don't have agendas. They're academic. They're trying to do research. So it has to happen at a university level. If Northern Trust or Goldman they approach me, they want to do something with it. They still have an agenda. Northern still wants you to deposit money in the Northern. Goldman, well, they've got a lot of inherent conflicts, but so everybody has different. A university doesn't. So I think that in order for this to move to the next level, it has to start at the university level. That's why I started at Stanford, and that's why we're starting at the new school, because they're more pure and they don't have an incentive. And you just go back to alignment of interest, right?
Mhm.
They're aligned. They want to do research. They want to do good things and teach and educate. The other conferences, they're for-profit conferences, and they're just looking for sponsors to pay for things.
Yeah. You said something earlier, and I wrote it in my notes, and I want to go back to it because I think it was valuable for us to hear and something for us to wrestle with. AUM is a conflict or potential conflict of interest when it comes to private deals, right? How is it justified, and when does it make sense?
Okay, so what I'm talking about AUM, I'm talking about from the GP level. If you're raising a fund, right, and you have the ability to raise, let's say your niche is in logistics, let's say truck parking or whatever it is, and ideally it's not a huge market. You could deploy $300 million into that. What you should do, and what few do, is they would raise 300 and then cap it. But up until a couple of years ago, so much money was flooding the market in the private markets that, well, hey, I can now raise $1 billion. So from a myopic standpoint, short term, yeah, it makes more sense for the GP short term, but it's going to hurt the investors, and it's worse for the investors, right? So the problem is that there's so much. If you're making 2% on $1 billion, and that's an annuity every single year, irrespective of how you do, it incents people to raise more money than they probably should. The best performing private equity funds are not the $10 billion funds. They're the 500 million to $1 billion funds, and they stay in their lane, and they allocate as much money as they need to do it effectively. And that's the problem. So it all goes back to alignment of interest.
Yeah. So when it comes to a management fee, right? You got to keep the lights on. You got to pay the assistants and the people, running the widgets and gadgets within the group. But you're saying that at some point, if 300 million is the right price, the right thing to go after. The conflict comes when you go raise more because, hey, shoot, if I raise an extra $100 million, that's another $2 million in our management pocket. So that's where the conflict lies.
When the industry started out, the reason it was a better model than the publicly traded companies is because, again, publicly traded companies and fewer companies, it's not fun to be a publicly traded company because you've got to report every 90 days. And a lot of companies are staying private longer, and a lot of the alpha is being created while the companies are private before they go public. So that's one thing. But I think that if you look at it from the perspective of, you know, the people who are raising the money, it used to be that 2% covers the overhead, right? 20%, I only make money if you make money. That's the 220 model. And it was a superior model. But then what happened, and it's human nature, not all, but many, they bastardized the business and it became an AUM game. And they realized if they can raise $2 billion and get 2% of that, even if a 500 million is the ultimate optimal amount to deploy, they're going to do that. Not everybody, but most. And so that's where I think it's become an inherent conflict. And that's where things like permanent capital, what family offices have, it is objectively a superior model. It's just very few families have the ability to execute. I think in 5 to 10 years, more and more will. And a lot of people who are looking to sell their companies, they're not going to go just to a strategic or private equity. They're going to go to a family office if they care about what the company's going to look like in 10 or 20 years.
Yeah. You mentioned North Star multiple times in our conversation. How does one determine what their North Star is?
It's just, well, that's specific to any individual. I mean, to me, it's just like, I look at myself as sort of like a practical dreamer. Like, you know, I'm 5'4", so I'd love to be a professional basketball player, but it ain't gonna happen. So I look at what these entrepreneurs who've created all this wealth, but there's a lot of, whether it's climate, poverty, you name the infinite inequality, you name the cause, there's a lot of good causes. I think that a lot of the family offices have a passion for something that's touched their family. And so when I say my North Star, again, it's not a panacea, but I do think that I kind of look at myself as the intersection of prosperity and purpose. So I'm a capitalist first, and I'm trying to maximize as much money as I make. But you could do that and also do things that are good and take these entrepreneurs. So when I say my North Star, it's basically taking these entrepreneurs, these guys like Michael Milken or Bill Gates or Eric Lefkowski, I mean, Sergey Brin has a predisposition for pancreatic cancer, so he's donated $1 billion. Is he going to solve it? I have no idea, but I put my money on him over the American Cancer Society just because the way he's wired. So that's what I talk about in my North Star.
What's your exit strategy, right? As your cross between, purpose and passion and profits and, capitalist first, like what does, you looking back on your life and saying, I did it, what does that look like?
It's totally different today than it was 20 years ago. It's all fluid. So like right now, am I working right now? I don't consider it work. Some people would say, yeah, you're doing a podcast, you're working. Everything is like a continuum. So some people would say, well, you're a workaholic. You do. It's not work to me. It's what I like to do. It's a passion. So to me, everything is fluid. It's very holistic. And whereas before it'd be like, okay, I want to get my hedge fund up to, I got it up to $250 million, and now I want to get it up to $500 million, and then I want to, make X, whatever, and then X it get this multiple. It gets to the point where at some point, you get to the point in life where I know a lot of very, very miserable billionaires, and I could. That's not if the goal if the purpose is to make as much money as possible, then don't listen to anything I'm saying. But it's a recipe for disaster, and it's a recipe for divorce and depression and all that stuff. And I see it all the time. I mean, the entrepreneurs, a lot of people who are listening to your podcast are entrepreneurs. I don't consider myself an entrepreneur. I mean, technically I was because I started my own company, but I didn't risk everything where I can go broke and I'd have to second mortgage the house. To be an entrepreneur is extraordinarily hard, but it's looked up upon. It's like this wonderful thing. The amount of depression and anxiety and suicide amongst entrepreneurs is off the charts. And for
Sure.
many people, it's just not worth it. So you have to understand yourself. So a lot of things that can go wrong is if you're wired as an entrepreneur and you have to create, then you do that. But if you're more conservative or and you don't want the real low lows and you're not wired that way, you should not be an entrepreneur. It's a hard thing to do. It's
Yeah.
not a good or a bad thing. It's just a choice. And if you're not wired that way, and I see a lot of people who take the entrepreneurial journey because they want to make a lot of money, but that's not the way they're wired, and they get depressed and they get anxiety and all this stuff happens. So I just think being true to yourself and knowing what you're good at, what you're not good at, and what your strengths and what your weaknesses are.
Yeah. Self-reflection and understanding thyself to thine own self be true. I've worked with a ton of dudes. I ran a men's podcast show. It did pretty well, and I spoke with thousands of guys, and it seems like guys have a really hard time identifying how they're wired, what they like to do, what they're good at, what, because we get stuck in the turning widgets and gadgets. We get so caught up in our work, we get so caught up in paying the bills. So when you talk about being how you're wired, that takes time and energy. How did you figure out who you were? Because you said I used to be like this, but now I'm like this. What was that point that helped you go on that path? I know you saw that one guy cry and you're like, this is weird, right? And it kind of changed your trajectory. But that's a learning path. That's an uphill climb. That's kind of against masculinity and manhood, especially your generation. How did that work?
Because you buy a house and it's a nice house and then you have a liquidity event and then you buy a nicer house and then you buy the nicer house and then some people will be like, well, I want to move into a nicer. So at some point, I mean, fulfillment and becoming self-actualized, which is the ultimate goal. It it if you go down the rabbit hole of I just want to keep getting and getting and getting, you'll never win. Um, there are people who, I typically, in most instances, when I teach at Stanford and some of in Wharton and some of the schools, I'm typically the dumbest and the poorest person in the room in general, and that's fine. I don't mind, right? Um, but I'm fine with that, right? I don't I like working with really smart people. And I'm fine if somebody's worth $10 billion and I'm not. That's okay. It's a mindset, and it's just being comfortable with yourself. And you get to a certain age, and think you just like at some point you just have to. I look at older people and look at people who I would want to be like in 10, 20, 30 years. And it's not the guy who's worth $20 billion who's just miserable and is trying to save all this money and do all these and buy all these things. It's the people who've got relationships. I mean, Harvard did a study, an interesting study. So I listened to like a lot of TED Talks. There was a TED
Mhm.
Talk. It was the longest longitudinal study, and they studied 250 kids out of Harvard from 1936 and 250 of the poorest kids in Boston. And they followed them, and the study's still going on. And they followed them. So some of these people are still alive. I think they're in their mid 90s now. But they were trying to figure out, and some of the people went from, poor to wealthy. Some people went from wealthy to into drugs and poverty. They were trying to find what's the secret, like what to live a fulfilling and happy life. And what they found is it's really one thing, and it's very simple. It's relationships. And you don't have to have 50 best friends. You could have one or two or four. It's the relationships, and the relationships that we make with other people. That to me is what's the most important thing, not the other stuff. And I think ego is a double-edged sword. I think ego is going to be understood much better in 20 years than it is now. It's starting to be understood better now. But, Brene Brown did a TED Talk on vulnerability. I would tell you 10, 20 years ago, vulnerability is a weakness. I
Yeah,
would tell you today, it's an absolute strength and it shows courage. It's just the way you look at things.
yeah. Ron, if let's say I'm coming to spend some time with you, but you're gonna create a great experience together, something that brings you a lot of joy. Like, what would that experience? Describe the experience that you would take me on, a new friend. Describe the experience that brings you a lot of joy that you would want other people to experience.
I really like it. Like, let's just say you love music, right? And I like music, but let's just say music is a passion of yours. I would love to go to a concert with you. And when I see somebody, like my wife's an artist, and I appreciate art, and I don't appreciate it. I don't have the level of appreciation. She's a world-class artist. She'll come home from work, and she'll start doing art. And I didn't understand that, because like when I come home from working, I want to watch ESPN and just tune it out. That's just the way she's wired. So to me, if we're going to go out, I love being around people that they're passionate about and sharing in their passion, right? And doing things that they like. If you're a foodie, I love food. I'm not a foodie per se, but I love good food. But let's say I knew you were a foodie. I'd love to take you to this Indian restaurant that, that's the best in the Midwest, and go there and see how you're enjoying it. And it's mostly, a lot of it has to do with being able to stay present, right? And
Yeah.
people are really bad at that. Like most people, even during a podcast, they might be thinking, after this podcast is over, I've got to do these 3 things and these 5 things, and I'm worried about this. In order to be, to me, the key is to be present. And it's very hard to do. And I'm good at it. I'm not great at it, but I'm
Yeah.
getting better at it, and something I'm working at. So it's just something, it's a work in progress that I'm getting better at. And most people they get older, they deteriorate, and they dread age. To me, I look at it as a positive. It's like I'm learning, yes, I'm going to have arthritis or whatever it is, but I'm learning more, I'm understanding more, I'm being more self-reflective, and I'm learning more about myself. And then with that comes wisdom, and um, that's nirvana. It's not, the people who, our society judges, we value youth, money, celebrity. But if you look at the people who are really rich and celebrities at a very young age, and you look at the suicide rate, it's off the charts. So maybe that's not the answer. So we have to go through pain, even though we don't necessarily want to. So I didn't want bad things to happen to me. I've had a lot of bad things happen to me. Everybody has. But if it doesn't kill you, it makes you stronger. And in retrospect, it's not that I'm hoping something bad happens to me tomorrow, but I know if something bad does happen to me, I'll be able to reflect and realize that at some point it'll be a growth period. And that's how we grow, is by having problems.
Yeah. I'm going to ask you a question, but I'm also going to put you on the spot for something. I want you to think of a question, and this is the first time doing this. I want you to think of a question that you'd like to ask me, right? So kind of like give you the microphone and let you be the host for a minute. But so while you're thinking that in the background of your mind, for people who want to connect with you and learn with you, and maybe get plugged into the future work that you're doing at the university level to teach this permanent capital model to family office. What's a good place for people to go start getting plugged in and and following your work?
I've got familyofficeworldmedia.com is sort of like the site to go. It's familyofficemedia.com, and that's kind of the site that people can go to and kind of see what I'm doing. I'm also fairly active on LinkedIn. I like to produce a lot of content, and to me, again, people are like, well, why would you write? It doesn't benefit you to write. It's like, it, I do it because I like to produce content.
Yeah.
It adds value, and no, it doesn't directly benefit me today or tomorrow or next week or not, or maybe ever, but it's just something that I like to do. So I think that, I've got clients who live in Florida because they pay less and they hate it, but they pay less taxes. Like, what about something called a happiness tax? What about living in Chicago, right? Being happy, paying more taxes, and living where you want to live. So it's not complicated, but I do think people get so caught up in this treadmill that we're on, and the world's moving so fast right now with the internet, and now with artificial intelligence. I mean, that's going to change everything. So it's just moving very fast. So what I consciously try to do is slow down, and I was not good at it before. I'm pretty good at it now, but I'm trying to get better.
Yeah, there's a happiness tax, which I've never heard it said that way. Like, yeah, it may cost more, may, be whatever.
How about not being miserable in Florida and you hate the weather and being around your grandkids in Chicago, and paying more taxes? Why wouldn't you do that? And
Yeah.
yet, most people, once you're worth a certain amount of money, well, the estate taxes are, and they are better in Florida or Texas, or
Yeah.
there's other places. So everyone's, they make enough money, they move there. Now, if you're happy in Florida, then that's the best of both worlds. You get
Yeah.
better taxes and you're happy. But I know a lot of people who will do that for the tax reasons, and that's not the right reason to do it.
Yeah, I'm in Florida, and it is the best place to live in the world, in my humble opinion. But there's also the PETA tax, right? The pain in the ass tax that you'll pay to avoid, right? Like, I'm not gonna mow my lawn because I hate doing it or whatever, so I'll pay that. Yeah. Anyways, I just had a brain misfire. Have you thought of any questions that you'd like to ask me, and maybe the audience? Maybe there's something curious that you want to know from the audience, and maybe get some response. So, what questions do you have about the world or deal making, or from myself or the audience that you have?
Well, I would guess I'd go specifically to you and just say, look, in 10 years from now, what do you want to be? And what I mean by that is not just I want to be worth X, or I want to have sold this company, or I want to whatever. Where do you want to be in life? Family wise, relationship wise, business wise, philosophically, all of these things.
Yeah. I'm going to be celebrating the 10-year anniversary of you asking me that question. We're going to be hanging out. We're going to go to a concert together, then do a pickup game of basketball, since that's one of your dreams to be a pro basketball. You and I are going to jam out, eat some food, and your wife and my wife are going to do some art together because they're the artists and we are not. But I think relationships, man, I just want to keep on nurturing great relationships where I'm learning and growing and building this community of conscious deal makers who are focused on making a positive impact in this world and our future generations. Let's build stuff that helps our grandkids, right? Let's stop thinking about how we're gonna buy another this or that today, but maybe like how do we set our grandkids up for success,
Do you have children?
Yeah, I got three kids, 11,
Okay.
7 at the time I recorded, 11, 7, and 4.
Okay, so mine are 20 and 23. But I will tell you, I 1,000 times rather get them a gift that I know they're gonna love than get a gift that, like, I love the Eagles. I'd love to see them at the Sphere. I get so much more enjoyment by seeing them, right?
Yeah.
And I think this is a mentality you have to develop.
Yeah, man, I loved hanging out with you. I found your work, and I'm going to encourage all the listeners in to go check him out on LinkedIn. He creates a crazy amount of great content, and that's where I found and dug in and then developed this relationship. So I want to encourage everybody to do that. As always, reach out to our guests. Say thanks for being on the show. If you have questions about deals, or if you'd like to share maybe some of the things that you do in the world of deal making, head over to thedealscout.com, fill out a quick form, and maybe we'll get you on the show next. Till then, we'll talk to you all on the next episode. See you guys.